And so I'm going to walk you through just the differentiation between risk on and risk off in 2011. So here is a chart of the United States stock market represented by the S&P 500. And as we've discussed, the market went absolutely nowhere, although we did have a 2% dividend yield, and by the end of the year, total return for the S&P was 2%. So the S&P was the risk-off market. The risk-on market, everything else. Okay, so the U.S. was the best performing market of scale on the planet. Outside the U.S., the returns were dismal. It was a pretty nasty bear market, frankly. So you can see ex-U.S., the world was down 15%. You can see in the euro area, we were down 19%. The emerging markets, 20% or so. The BRIC nations, the fastest growing economies on the planet with the fastest growing earnings, were down 25%, and ground zero in the PIG nations were down anywhere from 17 to 63%. And so to the extent that you're a global investor, this is a pretty bad setup, frankly. So the US market treaded water, everybody else got absolutely hammered. But even in the sideways US market, there were few areas where you could actually find return. So this breaks down the stock universe by size and style. And what you can see is the risk-on boxes of large cap, mega cap, US growth fared fine. Everything else got hurt. So small caps got hurt, mid caps got hurt, value as a discipline got hurt. Very few ways to win from a size and style perspective. And then by the end of the year, if you watched any CNBC, what you would have seen is people like me who speak always from hindsight, saying you should be only in large cap US dividend paying stocks. Anybody hear that last year? Yeah. Well, the reason you heard that last year was because that was the risk off center of the target. So within the S&P 500, the stocks that actually paid dividends, whether they were good stocks or bad stocks, on average were up 3.5%. Stocks that didn't pay dividends were down 3%. Part of the risk on, risk off environment. Okay, this is where it really got pretty zany. So risk off, the sectors that did the best last year from a return perspective were utilities, up almost 20%, consumer staples, and healthcare. I will tell you that, again, my economics trading was basically worthless last year because all of those sectors had higher average multiple than the market, right? They were more expensive than the market, and yet they had lower growth rates. So pay more for lower growth. Didn't make any sense, but they were grouped in the risk-off bucket, and so they performed well. Paradoxically, in the risk-on bucket, you had areas like energy, materials, industrials that had below market valuations and well above market growth. So, pretty screwy environment, frankly. And this is the kind of environment that makes it very difficult, like for active managers like us. You're almost set up for failure. And so if you look at, this is a chart going back to 1979, and it asks the question, what percentage of active growth managers ended up beating the index in any given year? And so for orientation, here's 2000, and in 2000, 90% of active growth managers beat the index. As I recall, that was a year when the index was down. WNA was actually up that year, I think. So that was an easy year to sort of win. Last year, 10% of growth managers actually outperformed their index last year, making last year the most frustrating year from an investment standpoint in many people's careers, a lot of the people I talked to specifically. By the way, hedge funds that are supposed to win in all environments were also down 5% last year. Let's talk a little bit about the fixed income side of the house. It was the same binary Pavlovian environment. In this chart, what I'm comparing is high yield corporates in the red line with treasury bonds in the blue line. And as you can see, early in the year, treasuries lagged corporates. And then, counterintuitively, tear up my economic textbooks, when the U.S. Treasury bond was downgraded, that inspired a lot of people to buy U.S. Treasury bonds. And so, again, we were back in silly season where the fundamentals didn't matter because we were trading off of feelings. But, as I mentioned to Stacy the other morning, and she liked it, and she said I should say it to you, in the short term, I forgot if it was Buffett or somebody who said this, the market is a voting machine. In the long term, it's a weighing machine. So while last year was driven in the voting booth by the emotions of the marketplace, over the long term, the fundamentals true up. And in the long term, we are fundamental investors. And so consumption actually in the US, counterintuitively, is at an all-time high. We have eclipsed where we were pre-recession, even with 8.3% unemployment. And in fact, the retail index in the stock market continues to climb to all-time highs. Never bet against the US consumer. All right, so let me give you a little bit of a drill down into what our expectations are for the economy. First of all, the economy, if you remember, is consumers, which represent about 70% of the piece, the government, which is about 20%, that doesn't include transfer payments, and then investment activity and a smidge to net exports.